Hello everyone, welcome to Hamza's Finance, and today I'm going to be talking about the recent news. The recent collapses of some banks, including the Silicon Valley Bank, have raised concerns about the potential impact on the economy. Many experts believe that the fallout from these banking collapses could lead to a slowdown in lending and financing standards, which could impact the economic growth of the US and also the world, because the US controls the world. The Federal Reserve officials have been clear that they expect a slowdown in bank lending to weigh on economic growth this year, but the magnitude is uncertain. If the banking turmoil blows over in coming weeks, lending and financing standards could return to normal. However, and the economic fallout might not be substantial. But if the situation continues or creates a knock-on effects like other banks fail in other parts of financial markets and the economy, the impact could be meaningful. If the banking trouble makes it harder to take out loans or issue debts, it means fewer businesses can expand and hire staff, among other troubles. Those problems could even be enough to push America towards a recession. Neil Kashkari, the president of Minneapolis Federal Reserve, said on CBS News Face the Nation that the recent banking turmoil definitely brings us closer to a downturn. He also noted that some capital markets have been largely closed for weeks, and if capital markets remain closed because borrowers and lenders remain nervous, then that would tell me this is probably going to have a bigger imprint on the economy. So it's going to be bad. The riskiest companies have been mostly frozen out of debt markets since early this month. At the same time, some of the healthiest corporate borrowers have managed to issue bonds again this week, a hopeful sign, though their purchase borrowing costs were unusually elevated. Investors and economists are watching for other risks like the effect of banking turmoil on the commercial real estate, which was already confronting pandemic-spurred office vacancies and which has traditionally relied on small and mid-sized banks for loans. With the scope of the fallout so unpredictable, Fed officials have been hesitant to react too decisively. Central bankers raised interest rates by a quarter point last week as they continued their fight against inflation, while also suggesting that they did not know what could come next. So you gotta be careful. Jerome H. Powell, the Fed chair, said at a news conference after a rate increase that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. But it is too soon to determine the extent of these effects and therefore too soon to tell how monetary policy should respond. In summary, the recent banking turmoil has raised concerns about its impact on the economy. If the situation continues, it could lead to a recession, and the Federal Reserve officials are closely watching the situation to determine the appropriate response. The banking troubles could make it difficult for companies to borrow money, which could limit their ability to expand and hire new staff, which can lead to more layoffs. Investors and economists are also watching other situations for other risks, like the impact on commercial real estate and other impacts like the layoffs. Federal Reserve officials have raised interest rates to combat inflation, but are hesitant to take any drastic action to respond to the banking crisis, because banking crisis is very important in the country. If banks fail, then everybody's money will be in risk. So thank you guys so much for watching, and don't forget to like and subscribe, and I'll see you guys in the next video.